This hearing of the Subcommittee on Oversight and Investigations of the House Financial Services Committee will come to order. Our hearing this morning is entitled The End of Excess, Part 1, Reversing Our Addiction to Debt and Leverage. Inspired from the April 6, 2009 Time cover story, right here, The End of Excess, Why This Crisis is Good for America, written by Kurt Anderson. This will be a first in a series of hearings where we will look at the key issues exposed by the financial crisis and next steps to continue improving financial stability in an economic recovery. We'll begin this hearing with members' opening statements up to 10 minutes per side, and then we'll hear testimony from our witnesses. For each witness panel, members will have up to 5 minutes to question our witness. The chair advises our witnesses to please keep your opening statements to 5 minutes to keep things moving so we can get to members' questions. Also, any unanswered question can always be followed up in writing for the record. Without objection, all members' opening statements will be made part of the record. I now recognize myself for up to 5 minutes for an opening statement. The strength of our financial system and economy depends on the responsible use of credit and debt built on trust between the lender and borrower that payment will be made in the future. The word credit is derived from the Latin word credo, which simply means I believe. While the financial industry complains about a lack of certainty as Congress debates financial reg reform, there's a more fundamental lack of trust that the American people now have in our financial system. To correct these two problems, this lack of certainty and understandable lack of trust, we must enact strong rules of the road this year so the credibility of our financial system can be restored. A new law alone, unfortunately, can't heal our broken financial system. The financial industry must take their own steps to restore faith in their business. They must provide services their customers really want and not use hidden fees or balance sheet tricks to cheat their way to the top again. We need to empower consumers and investors to make better financial decisions. Government must do its part in setting a good example, providing efficient financial oversight with limited resources, and getting on a path to balance the federal budget so we're not passing a massive debt on to our children and grandchildren. In 1978, our combined outstanding debt across the economy, including financial firms, other businesses, households, and local, state, and federal government, was $3.6 trillion, or 157% of GDP. By the end of last year, that number ballooned to $50.3 trillion, or 353% of GDP. This is the highest level of combined debt in the United States on record. Since 1978, our economy is over 6 times larger than what it was, and we've grown on average $404 billion each year. But over the same time frame, our combined debt has grown nearly 4 times as fast, adding nearly $1.6 trillion each year on average. Even more troubling is the rapid growth of financial sector debt, as it grew over 41 times larger than what it was in 1978. As GAO noted in its leverage study we'll hear about today, Wall Street investment banks had leverage ratios of over 30 to 1 compared to the largest commercial banks, which averaged leverage of 13 to 1. In good times, this means their profits were supercharged, but when asset prices fall, excessive leverage accelerates a firm's failure, as we saw with Bear Stearns and Lehman Brothers. Are we addicted to debt and leverage? I'm afraid we might be. And unless we take bold new steps on both financial reg reform and budget reform soon, it'll be very difficult to reverse this troubling trend. When I came to Congress in 1999, it was the last 2 years of the Clinton administration. We had budget surpluses those 2 years, and the first government surpluses in decades. When President Clinton left office, the national debt stood at $5.73 trillion. Unfortunately, the next 8 years, our national debt grew at a record pace, nearly doubling and hitting $10.7 trillion. Our economy was on the verge of going off the cliff as we were still reeling from TARP and the financial panic in late 2008, and our economy was losing 750,000 jobs a month in early 2009. Experts and economists from the left and the right, including John McCain's economic advisor, Mark Zandi, implored Congress to act with a large stimulus to stabilize the economy. So even though it wasn't popular, the government responded by enacting the Recovery Act, and TARP was used to implement the Financial Stability Plan. What happened next? The economy stabilized, and slowly but surely, we are back on track with real economic growth. Our Republican witness, Professor David Walker, agrees in his testimony, writing, quote, our economy would be rebounding much more slowly than it has if we had not implemented the TARP program, end quote. Congress has made strong budget reforms, passing the largest deficit-reducing legislation since 1993 in the new health care law. We've re-implemented statutory pay-go, and the President established a Fiscal Responsibility Commission with a report due at year's end. I look forward to hearing from our witnesses on these issues today, bringing their experience and expertise on these matters so we can better understand how debt and leverage impacts every single American, and what other steps Congress can take to get us back to a more stable path of economic growth. I now recognize for 5 minutes the distinguished ranking member of our subcommittee, my colleague and friend from Illinois, Ranking Member Judy Biggert.
Thank you, Chairman Moore, and thank you for convening this important hearing. Today's hearing is entitled The End of Excess, Part 1, Reversing Our Addiction to Debt and Leverage. However, I would like to add to that. I would add that Washington must reverse its addiction to big brother government, wasteful Washington spending, and permanent taxpayer-backed government bailouts. The denial in Washington must end. Washington must get on the side of the American taxpayer, American families, community-based financial institutions, and American small businesses, the job creators in our economy. Our nation's debt is on an unsustainable track. The denial of some lawmakers that Washington takeovers, bailouts, and spending is out of control must end. The front page of today's Washington Post reads, Greece's debt pain sparks violence, and as we've all seen in the paper. This European debt crisis will seem like a drop in the bucket when compared to our nation's projected debt, which by some estimates will reach $15 trillion by the end of 2020, representing 67% of GDP. Levels of debt that are of this nature are not sustainable and represent a barrier to the future economic prosperity of our nation. High taxes, inflation, and higher unemployment rates will be the byproducts of the current administration's fiscal irresponsibility. Linked to this irresponsibility is the administration's unlimited guarantee of the debt of Fannie and Freddie. With trillions in obligations that are guaranteed by our government, our taxpayers, Freddie Mac announced yesterday that we'll need an additional $10.6 billion in government funding. That's $10.6 billion more of taxpayers' money. The latest addition brings the GSE loss to taxpayers to $136 billion. And with that, Mr. Chairman, I would like ask unanimous consent to insert in the record three newspaper articles. One from Bloomberg saying Freddie Mac seeks $10.6 billion from Treasury following first quarter loss. From the New York Times, Freddie Mac seeks billions more after big loss. And from the third from Politico, Frank to White House fight the GOP.
Without objection, they'll be received.
Thank you. The administration has yet to even appoint an inspector general to provide objective, independent oversight over the federal bureaucrats who now control the GSEs. And I know you've had that bill to do that. It is inconceivable that officials managing these liabilities would be allowed to do so without proper transparency, independent oversight, and thorough reporting to Congress and the American people. And it's unacceptable the administration continues to kick the can down the road and still has no firm exit strategy to spare taxpayers from future losses associated with Fannie and Freddie. Republicans are ready to address this problem and get taxpayers out of this mess. Finally, the risk takers on Wall Street need to know clear rules of the road. The rules must say that there will be no more bailouts and no more institutions too big to fail. This message should be clear. If you run your company to the ground, you'll be shut down. Your creditors and counterparts won't get a bailout that's paid for by taxpayers, consumers, or community banks and small businesses that have had no role in your risky behavior. I look forward to the testimony of today's witnesses. I'm particularly interested in the findings of the GAO study from last July that clearly point to the fact that because institutions thought housing asset value, primarily housing prices, would continue to rise, institutional leverage increased. When these institutions began to experience significant losses due to the decline in value of mortgage-related and other assets, financial institutions attempted to deleverage and reduce their risk by raising new equity, reducing dividend payouts, selling assets, and reducing lending. Raising capital, however, became increasingly difficult after the onset of the crisis as would-be investors began to have doubts about the quality of these firms' assets, and financial institutions began to deleverage by selling assets. In the fourth quarter of 2008, broker-dealers reduced assets by nearly $785 billion, and banks reduced bank credit by nearly $84 billion. This series of events significantly contributed to our economic crisis. Today, our economy is essentially on thin ice and susceptible to even the most moderate economic shocks, according to GAO. It's for this reason that in the reform proposal, H.R. 3310, House Republicans proposed a market stability and capital adequacy board to monitor these interactions. Congress doesn't need to bestow more power on the same Washington bureaucrats that didn't do their job at policing the financial industry or protecting consumers in the first place. Regulators need to get their act together. We must enact smart financial reforms that require coordinate regulatory efforts and bailouts and bring certainty to the marketplace so that investors invest, businesses expand, and more jobs are created to put Americans back to work. Finally, until our federal house is in order, our children and grandchildren will be the ones who will bear the burdens associated with our nation's addiction to excessive borrowing and spending. And with that, I would yield back.
Thank the ranking member. I next recognize Mr. Lynch from Massachusetts for 2 minutes, sir.
Thank you, Mr. Chairman, for holding this hearing, and I also want to thank our distinguished panelists for their willingness to come before this committee to help us with our work. Mr. Chairman, our nation's growing addiction to debt is one that had been largely ignored until the collapse of the financial markets in the fall of 2007. According to the Federal Reserve, at the end of 2009, the combined outstanding debt in the U.S. economy was $50.3 trillion. That includes financial industry debt, non-financial business debt, household debt, and local, state, and federal government debt. Since the boom years began in the 1980s, our debt as a percentage of GDP has risen almost 200%. And while there are a lot of things that happened since the early 1980s, and some of that factor might be mitigated, I think the increase in our debt has been instructive as to where we've been and where we're going. As we know all too well, no other industry was as highly leveraged and addicted to debt as the financial system. We've learned that Lehman Brothers and probably other banks used techniques like the Repo 105 to conceal debt, masking just how highly leveraged they actually were from regulators and investors. Collateralized debt obligations and other over-the-counter derivatives were multiplying and disguising or transferring debt off the balance sheets of companies into opaque markets such that regulators and market participants could only guess at the total amounts involved in these deals. The regulatory reform bill that the House passed last year, the Wall Street Reform and Consumer Protection Act, would establish a Stability Oversight Council to give regulators better tools to monitor and regulate excessive leverage and risk-taking. I know my colleague, Mr. Miller, has introduced a bill that mirrors a number of amendments that the Senate is currently considering to their regulatory reform bill, limiting the size of mega banks by setting a cap on any company's share of total deposits and setting minimum equity levels for bank holding companies and non-bank financial institutions. I think these are steps in the right direction, and I'm looking forward to hearing from our witnesses today on further proposals to help wean ourselves from this harmful addiction to debt. Thank you, Mr. Chairman. I yield back.
Thank the gentleman. The chair next recognizes Ms. Spear from California for 3 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses for participating in what is a very important hearing. This hearing on the impact of leverage and increasing debt burden is profound. I'm struck by the fact that the two sectors that dramatically increased their debt burden leading up to the current economic crisis were the financial sector and consumers. And we know that it was the financial institutions that fostered the growth in consumer debt through teaser interest rate credit cards and loans, no-down auto loans, 228 and no-doc pick-a-pay payments, mortgages, and home equity loans, all so that they could be packaged into bonds and CDOs and synthetic CDOs that magically received AAA ratings and generated enormous fees and profits. I strongly believe that excessive leverage used by the large financial institutions was a major factor in the real estate bubble and subsequent financial collapse in 2008. In fact, according to Professor David Moss of Harvard Business School, outstanding debt in the financial sector, and this figure is truly mind-blowing, increased from $568 billion in 1980 to more than $17 trillion in 2008. Leverage helped firms become too big to fail. A firm with $1 billion in capital can have $40 billion in liabilities, which means that if it goes down, there are other banks and lenders who need $40 billion in repayments if their balance sheets are going to add up. The banks that survived the crisis best, like J.P. Morgan, had the lowest levels of leverage. The leverage ratio at Bear Stearns reached more than 40-to-1 before it failed. By 2007, the leverage ratios of many of the major Wall Street investment banks reached more than 30-to-1, including Lehman Brothers and Merrill Lynch. But these are only their on-balance sheet levels. These firms also gamed their leverage numbers by using off-balance sheet vehicles and tricks like repo 105s to make their balance sheets look better than they really were. The fact that most of this was short-term debt simply made the matters worse. When the real estate bubble burst and supposedly liquid mortgage-backed securities suddenly became unsellable, causing a downward spiral. I feel compelled to set the record straight. We are here today not because of overregulation, but because of systemic and systematic deregulation. With the passage of the Gramm-Leach-Bliley Act in 1999, the Commodities Future Modernization Act in 2000, which prohibited Congress from regulating derivatives, and the SEC's Consolidated Supervised Entities Program in 2004 that led to a relaxation of leverage ratios for investment banks, which then were 12-to-1. They just lifted it all together. Regulators still have the power to take many actions in the months and years leading up to the current crisis, but they didn't believe there was a problem. Up until the bitter end, they asserted that there was no bubble and that the market would take care of itself. Well, it didn't. I'm gratified that the House Wall Street Reform and Consumer Protection Act includes my amendment that would limit debt to equity leverage at systemically risky firms to no more than 15-to-1. The regulators could still impose a lower limit. I'm delighted that Thomas Hoenig, president of the Federal Reserve Bank of Kansas City, is here. He has said publicly that he believes that there must be a leverage ceiling. In fact, he has said that 15-to-1 is too generous. I might add that Goldman Sachs is presently leveraged at 15-to-1 today and breaking its own records for profits. It may be impossible to devise a truly foolproof regulatory regime to prevent the next crisis, but we should not again be totally reliant on the wisdom and good intentions of government regulators or voluntary restraint by Wall Street firms. I thank the chairman. I yield back.
I thank the lady for her statement, and I'm pleased to introduce our first panel of witnesses. First, we'll hear from Mr. Thomas Hoenig, President and CEO of the Federal Reserve Bank of Kansas City. Welcome, Mr. Hoenig, Mr. President. And next, we'll hear from the Honorable David M. Walker, President and CEO of the Peter G. Peterson Foundation and former Comptroller General of the United States. Welcome to you, sir. It's an honor to have such distinguished current and former public officials before our subcommittee today. Without objection, your written statements will be made part of the record. Mr. Hoenig, sir, you're recognized for 5 minutes to provide a brief summary of your statement.
Chairman Moore and Ranking Member Biggert and members of the committee, I want to thank you for asking me to testify here today and to give me an opportunity to share some of my views on the issues around leverage. Certainly among the factors that contributed to this financial crisis, there is no question that leverage was key. And the unwinding of this leverage contributed to the escalation of this crisis into the worst recession in 75 years, hurting Americans at all economic levels. I have spent more than 36 years at the Federal Reserve, deeply involved in bank supervision, and it has been apparent, to me at least, for some time that our nation's financial institutions must have firm and easily understood leverage requirements. Leverage tends to rise when the economy is strong, as investors and lenders forget past mistakes and believe that prosperity will always continue. If we don't institute rules now to contain leverage, another crisis, I can tell you, is inevitable. My written testimony addresses the systematic increase in debt and leverage that has occurred in all major sectors of our economy over the past 2 decades. But my comments today will focus specifically on what occurred at the largest financial firms, which were the catalyst in many ways for this crisis. Leverage, of course, is the ability to use debt to build assets as a multiple of a firm's capital base. The leverage at banking organizations has risen steadily since the mid-1990s. It was not immediately obvious because of the many different ways capital and leverage can be measured. In my judgment, the most fundamental measure of a financial institution's capital is to exclude intangible assets and preferred shares and focus only on tangible common equity, that is, ownership capital actually available to absorb losses and meet obligations. Looking at tangible common equity, you see that leverage for the entire banking industry rose from $16 of assets for each dollar of capital in 1993 to $25 for each dollar of capital in 2007. More striking, perhaps, this aggregate ratio was driven most significantly by the 10 largest banking companies. At these firms, assets rose from 18 times capital to 34 over the same period, and that does not include their off-balance sheet activities. These numbers, in my opinion, reflect two essential points. First, that based on capital levels, the 10 largest banking organizations carried fundamentally riskier balance sheets at the start of this crisis than the industry as a whole. Second, their greater leverage reflects a significant funding cost advantage. Not only is debt cheaper than equity, but their debt was cheaper than the smaller organizations because creditors were confident that these firms were too big to be allowed to fail. This was a gross distortion of the marketplace, providing these firms an advantage in making profits, enabling them to build size, and then, in the end, leaving others to suffer the pain of their collapse. This is not capitalism, but exploitation of an unearned advantage. And the list of victims is long, including families who lost homes, workers who lost jobs, and taxpayers who were left to pay the tab. This increase in leverage in the banking industry spread broadly to other sectors of the economy, creating a general excess of credit growth over the past 10 years, especially, as you said, among consumers. This economy-wide rise in leverage was based on the assumption that asset prices would continue to rise, especially those in housing this time. When prices fell and defaults and losses mounted, capital ratios that had been systematically reduced over time proved grossly inadequate. To illustrate, suppose the 10 largest banking organizations had been required to confine their leverage to an historically more reasonable level of $15 of tangible assets for every dollar of tangible common equity rather than the 34 they had. Under this historic limit, they would have been forced to hold an additional $326 billion of equity, 125% more than they actually had, to absorb potential losses. Or they would have had to cut back on their growth by nearly $5 trillion, or more likely the combination of those two. The point is, the institutions got away from the fundamental principles of sound capital management, and those institutions with the highest leverage suffered the most. Financial panic and economic havoc quickly followed. The process of deleveraging is still underway. Rebuilding capital has begun, but during this rebuilding, loans are harder to get, which is impeding the economic recovery. With this very painful lesson fresh in our mind, now is the time to act. I strongly support establishing hard leverage rules that are simple, understandable, and enforceable, and that apply equally to all banking organizations that operate within the United States. As we saw in the years before the crisis, leverage tends to rise during the expansion as past mistakes are forgotten, and pressure for growth and higher returns on equity mount. Straightforward leverage and underwriting rules require bankers to match increases in assets with increases in capital and prevent disputes with bank examiners over interpretations of the rules. As a result, excess is constrained, and a counter-cyclical force is created that moderates booms and forms a cushion when the next recession might occur. I firmly believe that had such rules been in place, we would have been spared a good part of the tremendous hardship the American people have gone through during the past 2 years. Thank you.
Thank you, Mr. Hoenig. And the chair next recognizes the Honorable David M. Walker, sir. You're recognized for 5 minutes.
Chairman Moore, Ranking Member Biggert, members of the subcommittee, thank you for the opportunity to testify today. It's very important to state at the outset of this hearing that not all debt and leverage is bad. However, excess debt and leverage is. In addition, individuals, businesses, and countries must not become accustomed to taking on debt in order to finance their ongoing operating costs and current wants, at the expense of future needs and future generations. Now let me turn to the state of the U.S. government's finances, which is what I was asked to focus my testimony on today. It is clear that the United States is a great nation, possibly the greatest in the history of all mankind. At the same time, our country is resting on its past successes and its sole superpower status, which is temporary, while at the same point in time ignoring a range of leading indicators that clearly demonstrate that we are on an imprudent and unsustainable path in many respects. This includes matters such as public finance, savings rates, educational performance, healthcare costs and outcomes, and the state of our nation's critical infrastructure. The truth is, our country's future standing and standard of living for future generations of Americans is threatened by these key sustainability challenges. And given the subject of this hearing and series of hearings, I'll focus my remarks on America's structural deficits, growing debt burdens, increased reliance on foreign lenders, and low savings rates. During the first approximate 200 years of our republic's existence, the federal government did not experience significant and recurring deficits unless the country was at war, meaning a declared war, was experiencing a depression or recession, or faced some other major national emergency. However, within the past several decades, both America and too many Americans became addicted to spending, deficits, and debt. This cultural challenge is real, and it's reached epidemic proportions in Washington, D.C. As an example, total federal debt levels have more than doubled in less than 10 years, and they could double again within the next 10 years on our present path. Clearly, trillion-dollar deficits are a matter of growing public concern. However, it's important to understand that today's deficits do not represent the threat to the ship of state. It's the large, known, and growing structural deficits that will exist when the economy has recovered, when unemployment is down, when the wars are over, and when the crises have long passed. These literally threaten the future standing of the United States and the future standard of living of Americans. And as we can see, that absent dramatic and fundamental spending and tax reforms, our federal debt levels are expected to skyrocket in the future. Believe me, the markets will not allow us to get nearly very far down this road. Federal spending levels have grown by almost 300% net of inflation over the past 40 years, and the federal budget is now dominated by mandatory spending programs that grow on autopilot. These mandatory spending programs serve to constrain our ability to invest in our children, in critical infrastructure, and other areas that help to create a better future. As I have traveled the country and appeared in the media promoting the need for fiscal responsibilities, many have asked, are we Greece? Their question is based on the current challenges being experienced by that country, and the answer that I typically give is the U.S. is not in the same situation as Greece today. However, our key public debt ratios will be as bad as Greece's in less than 10 years. And given our present path, we must learn the lessons of Greece and past history if we want to avoid a similar crisis of confidence. Today's paper notes riots in the streets of Greece. This could happen in the United States in less than 10 years on our present path. Today's paper notes the dominance of concern in Britain about public debt. And as you will see, most Americans don't realize, including most members of Congress in all likelihood, that our key total public debt ratios exceed Great Britain. They exceed Spain. They exceed Ireland. They're not as bad as Greece, but they'll be there within less than 10 years. The truth is the debt to GDP numbers that the federal government pushes on the public tend to understate the nation's true leverage. For example, current debt held by the public is about 58% of GDP and rising. However, if you add debt that's owed to Social Security and Medicare and other so-called trust funds, the debt to GDP ratio would be 89%. And if you consider the debt that's held by Fannie Mae and Freddie Mac, which many believe should be consolidated with the U.S. government's financial statements, we're well over 100% and rising rapidly. What about savings rates? Savings rates have declined dramatically, and the net national savings rate has plunged to the lowest level since the Great Depression. We must recognize reality and understand that the four factors that cause the mortgage-related subprime crisis exist for the federal government's own finances. Specifically, a disconnect between those who benefit from prevailing practices and those who will pay the price and bear the burden when the bubble bursts. Second, not enough transparency as to the nature, extent, and magnitude of the real risk. Third, too much debt, not enough focus on cash flow, and over-reliance on credit ratings. And finally, a failure of existing governance, risk management, oversight, and regulatory functions to act until a crisis was at the doorstep. In my view, in summary, while America is a great nation, we are at a critical crossroads. The decisions that are made or that fail to be made by elected officials over the next 3 to 5 years, especially in the fiscal area, will largely determine whether our future is better than our past or whether our best years are behind us. We must move beyond delay and denial, and we must start making tough choices. And we must do so before we pass a tipping point, which is what happened in Greece. If you look what happens when you pass a tipping point and you lose confidence of your foreign lenders, interest rates can escalate dramatically, which can set off a chain of events that not only would have adverse economic consequences in the United States, but dramatic adverse consequences around the world. The United States will not default, but we may well have to pay much higher interest rates in the future because of not as much concern about default, but concern about what is the dollar worth that you're going to get repaid in. Thank you very much, and I'd be happy to answer your questions.
Thank you, sir, for your testimony. Mr. Hoenig, thank you for testifying today and for your 36-plus years of service with the Fed. You and your staff at the Kansas City Fed have been leaders in our community and an invaluable resource as our country has slowly managed our way through the financial crisis. As both you and Mr. Walker pointed out, leverage is a double-edged sword and can be responsibly used for productive economic outcomes. But it seems in the last decade especially, discipline was sacrificed for excessive risk-taking at times. Would you elaborate on your point that, quote, the greater leverage reflects a significant funding cost advantage, end quote, for larger firms? I agree with your views that this represents a gross distortion of the marketplace and is an exploitation of an unearned advantage. Can you help us better understand this point, sir?
I hope so. The way I would start with is if you looked at my final comments with how much additional capital would take to have what I think is a reasonable leverage ratio in terms of tangible capital, you would have to raise over $300 billion. Equity is more expensive, and therefore, by not having to raise that, to be allowed to have a higher leverage ratio, your cost of funding was in effect less because smaller institutions who are not too big to fail, of course, don't have that advantage. So you really have, you've biased the outcome towards the largest institutions. They don't have to raise as much capital, therefore their costs are less. Plus, they're thought to be too big to fail, therefore their credit costs as well are less than you would have in a regional bank that everyone knows could be closed if it were to fail. So that's a huge advantage, and it perpetuates the ever-increasing size and consolidation of the financial industry. Because think about it. If you're on that borderline as being thought too big to fail, you've got to go and get a merger partner and get above that threshold and bring your costs down. So it has a very perverse incentive system that I think harms us.
Thank you, sir. At the end of your testimony, Mr. Hoenig, you note that critics will oppose more conservative capital ratios on the grounds it will restrict growth. You admit it will, but the point that everyone seems to miss is that runaway excessive growth and dependence on leverage and debt is unsustainable and dangerous, puts all Americans at risk. We need to return to a more sustainable and responsive, do we need to return to a more sustainable and responsible use of leverage and debt? Is that correct?
Absolutely correct, sir. I'm convinced, I mean, I've been told many times that if you put these leverage constraints, you make it a rule of, say, 15 to 1, that during the growth period you will constrict growth, and my answer is yes. That's the nature of a sound fiscal management, that your capital requirements limit you. So if you want to go out and grow your balance sheet, you have to raise new capital to do so, which keeps it sounder, but also keeps the growth from running away. So under those conditions, under having firm rules, the capital ratios become countercyclical. When you allow them to move, they become less restrictive during the growth period and more restrictive during the recession. You get a pro-cyclical. The boom is bigger and the recession is much worse, and that's what we want to avoid. I think this would do it.
Thank you, sir. Mr. Walker, thanks for your years of public service and what you've done to raise awareness about our long-term budget challenges. First, I think you make a great point in your testimony that all debt and leverage is not bad, and with its responsible use, it can lead to productive economic activity. But like our addiction to foreign oil and the dangers that pose to our national security, you note that with, quote, our low savings rate and large spending appetite, America has become unduly reliant on foreign investors to finance our federal deficits and debt. Would you explain, sir, how our dependence on excessive debt may be a threat to our national interest? Go in more detail, if you would, sir, please.
Yes, I will. First, the fastest growing expense in the federal budget today is not health care cost, although they do threaten our future. It's interest cost. Within 12 years, without a risk premium for interest rates, the single largest line item in the federal government's budget will be interest on the federal debt, and we get nothing for that. If we have to start paying a risk premium, say 200 basis points or 2%, by 2040, the only thing the federal government could pay based on historical revenue levels is interest on the federal debt. We get nothing for it. So the fact is we have to recognize that by having excessive leverage, we are crowding out our ability to invest in our future. In addition to that, we are placing at risk the possibility of passing a tipping point, whereas foreign investors may decide that they want to charge us higher interest rates in order to offset any potential risk, not as much of default, but of a significant reduction in the value of our currency and therefore their effective yield. We are a great country, and we benefit from the fact that we have 64% of the world's global reserve currency. That gives us more rope. It gives us more time. But ultimately, we are not exempt from the fundamentals of finance, and yet we act like we are. We're talking about our future national security, our future international standing, and our future standard of living. Last thing, I think we have to recognize reality. There's two kinds of taxes. There's current taxes and there's deferred taxes. And to the extent that you run large deficits, those represent deferred taxes that will have to be paid with interest. So this is not just an economic and national security issue. It's a moral issue.
Very good point. And Chair next recognize. Thank you for your answering my question, sir. Chair next recognizes the ranking member, Ms. Biggert, for 5 minutes.
Thank you, Mr. Chairman. Mr. Hoenig, the bill that is before us, the regulatory reform bill that Democrats have proposed, isn't it, if they have the too big to fail, and that's problem, isn't it likely that the leverage problems will become even worse in the future?
If we fail to address the too big to fail issue, then the leverage issue and the consequence from that will only get worse through the next cycle. In other words, all the banks are deleveraging right now because of the pressure. But once the economy turns around and we begin to expand again, the leverage, the drive for leverage will increase as return on equity demands, return to investors becomes a paramount focus by that CEO, and the re-leveraging will start again, and we will repeat the cycle, in my opinion. So that's why we need to have, I think in the legislation, firm leverage rules that the rule of law then dictates that inhibits that from happening, and it will, in fact, inhibit the growth of some of these largest institutions by taking their advantage away.
What then do we do when if they have funding advantages, and the creditors, since they seem to have a different status, the creditors will be more likely when they monitor not to be as vigilant when they look at the institution's leverage, so that it would go up. Right. Is that a potential problem too?
Yeah, as long as we do not address too big to fail, that is not a potential but an immediate real problem. The creditors have to be under, and that's why I prefer a rule of law that takes away discretion from the bureaucrat or from the policy person, so that in the crisis you don't have that option to bail out, so that you have to take certain steps controlled to prevent a financial meltdown as such, but we can do that. And then the creditor knows that they will be in line and they will get
So
their funds.
it'd be like an enhanced bankruptcy.
That's correct. An enhanced bankruptcy or a failure process that assures everyone that the largest institution will be dismantled if it fails.
Okay. How has recent Fed policy encouraged the use of debt financing?
Well, in the sense of this past cycle, I'm on the record as saying that when you keep interest rates exceptionally low for an extended period, you are encouraging credit because, of course, it's cheaper to borrow than to raise equity. It's more convenient, and therefore you encourage credit. So you add to the incentives by keeping interest rates lower than they would otherwise be under normal market supply and demand conditions. So that's one of the issues we have to confront.
Okay. Thank you. Mr. Walker, then you point out some alarming numbers and alarming other things too, and thank you for your testimony that don't scare everybody to death. But regarding the federal debt, when you account for the debt owed to Social Security, Medicare, and the total GSE liabilities, what should be done regarding the GSE debt? In other words, you talk about mandatory spending, we have to reduce that. Is really, our discretionary spending is really not near the amount of the mandatory, but how does the GSE liability fit in there, and what should be done with their debt, and can we continue to fund Fannie and Freddie as we're doing now?
Well, first, in my personal view, the debt that's owed to the Social Security and Medicare trust funds should be deemed to be a liability. On one hand, we hold it out as an asset. We tell the beneficiaries of those programs that you can count on it. It's guaranteed by the full faith and credit of the United States government, both as to principal and interest. We won't default on it, but yet right now it's not considered a liability. And so therefore, if it was, and by the way, it is part of the total debt subject to the debt ceiling limit, then our current debt to GDP ratio would be 89% and rising rapidly. The issue of Fannie Mae and Freddie Mac is a little different. We do account for transactions such as the $100 billion plus that we provided to them. The Treasury has now guaranteed trillions of dollars of Fannie Mae and Freddie Mac debt. That's a contingent liability. But now the federal government essentially controls Fannie Mae and Freddie Mac, and one of the questions that's going to have to be answered for this year's financial statements is should they be consolidated into the financial statements of the United States government. Current accounting allows for that not to happen if it's temporary. It's not so clear to me how temporary this situation is, and so it's something that's very serious that we need to focus on. Bottom line, we're in worse shape than we tell people, and we need to recognize reality that we're not exempt from the fundamentals of finance, and we need to do what it takes to avoid what's happening in Europe right now.
Thank you. My time is up. I yield back.
Thank you. And the chair next recognizes Mr. Lynch, Massachusetts. Sir, you have 5 minutes.
Thank you, Mr. Chairman. I want to thank you both for your willingness to come before the committee today, and I also thank you for the frankness of your testimony. And I share a lot of that same sentiments about where we're heading. One of the particular areas I think that, and let's go to the too big to fail discussion, and we talked about the 10 banks that really exceeded, by everyone's estimate, the existing capital structure regulation, and they accomplished that. We had regulations in place about how much leverage there could be for these banks, and what they did is they used derivatives. They used these special purpose vehicles, used them by several names, but basically In many cases, they contain these collateralized debt obligations or collateralized loan obligations, and they moved that debt off their balance sheet. And that way, they were able to stay within the regulatory framework, at least nominally, until it hit the fan, and these folks had to take all that stuff back on their balance sheets because there were no buyers, and those investments basically deteriorated. That allowed these banks, that practice allowed these banks to become too big to fail, in my opinion. I'm just wondering what you think about the Senate version of financial services reform, and also the House version, where we've put some limits on these derivatives. We've established exchanges, which provides for transparency. We've provided for clearinghouses, and I'm a little bit nervous because it still allows these clearinghouses to be owned by these 10 banks. Matter of fact, 5 of the banks own 97% of all the clearinghouses, and that troubles me greatly. But there's also a dark market that is maintained for unilateral trading of these complex derivatives that go on between individuals. And so I'm nervous about the perpetuation of this practice of moving stuff off the balance sheet, and that has allowed this leverage to go on. And I'd just like to hear from each of you whether or not you think my fears are unfounded, or perhaps you might suggest a way of getting at that. Thank you.
I think your fears are well-founded. I think the amount of off-balance sheet activities with certain kinds of derivatives and synthetic derivatives have contributed to this crisis. I think that would be hard to refute, actually. I do believe that the legislation should provide, number one, for better disclosure and for requiring these institutions to keep a portion of that on their balance sheet, whether it's 5% or 10%, so that you can monitor, and they have some skin in the game, if you will, to monitor that off-balance sheet activity. That's number one. Number two, on your exchanges, I'm very strongly supportive of a clearinghouse, but even exchanges to where you bring it to the light of day, that a market discovery price is more available. People can not behind the scenes, a stock market, manipulate to say push something so they can gain in a short position and so forth. I know there's a lot of discussion right now in the Senate on those particular industry players, whether it's for fuel to hedge, but I think that can be dealt with, and the main objective should be to get those in the open. And I think the more objective, that is a clearly regulated exchange or clearinghouse where it has rules that it abides by, would be the best outcome for the American people and for the financial industry, actually.
I think clearly with regard to the private sector, there's no question that there needs to be tougher capital requirements that gives appropriate consideration to derivatives. In addition to that, there needs to be more transparency, no question, better oversight than historically has been the case. But let me remind you that you're correct, Congressman Lynch, that these special purpose entities were, and the use of derivatives in ways that didn't mitigate risk but enhanced risk was part of the problem. You know, the federal government has special purpose entities too. They're called trust funds. And one could argue that GSEs might be deemed to be special purpose entities too. So we need to practice what we preach. You know, we need to do what we need to do with regard to institutions and instruments that represent systemic risk, but we also need to put our own financial house in order and make sure that we're leading by example in practicing what we preach.
Thank you. I yield back.
Thank you, sir. And the chair next recognizes for 5 minutes Mr. Driehaus, sir.
Thank you very much, Mr. Chairman. Thank you for holding this hearing, and I appreciate the testimony of the two witnesses. I think it's an issue that while we talk about it from time to time on the surface, very rarely do people dig down and try to get towards solutions when it comes to our indebtedness. I was very interested, Mr. Walker specifically, in some of the solutions that you had focused on in your testimony. One of those being the issue of tax expenditures, which I think the vast majority of Americans pay very little attention to. This idea that we as a federal government forego over $1 trillion in tax revenue is very serious. I describe it as a revenue stream that looks like Swiss cheese because of all of the carve-outs that exist, not just, and it happens in the states as well as in the federal government. But what ends up happening is the rates that are then applied don't really bring in the revenue that it suggested that they otherwise might. Instead, you have a situation where government is picking winners and losers in the economy, which only leads to a declining revenue stream. The challenge, though, is that anytime you try to close one of those loopholes, any time you try to close one of those intentional carve-outs, you're accused of raising taxes. As you look at the President's commission to address the deficit and the debt, how do we treat the tax code, especially tax expenditures, so that they're no longer being viewed as political football, but that we have a long-term sustainable tax policy that businesses in the United States can actually count on, while actually lowering the rates, in my opinion, because I think you can close a lot of loopholes and dramatically lower the rates. But I'd be very interested in your comments.
Well, first, there's two kinds of spending. There's front door spending, which is about $3.8 trillion for this year, and there's backdoor spending, which is the revenue that we lose because of tax preferences, deductions, exemptions, exclusions, credits, et cetera, over $1 trillion a year. They're not in the budget. They're not in the financial statements. They're not part of appropriations, and they're not systematically reviewed for reauthorization. That's got to change. We have to take a hard look at them to understand whether or not they're future-focused, results-oriented, to try to understand who is benefiting from them. And in many cases, quite frankly, they fuel problems. For example, the largest tax preference is the exclusion from income and payroll taxes for employer-provided and paid health care. That fuels health care cost increases. It creates great inequities between the haves and the have-nots. I think it's important that that be on the table. It's got to be part of comprehensive tax reform. And quite frankly, I think ultimately what the federal government's going to have to do, it's going to have to employ a special process, possibly with outside experts, to go through a disciplined, independent review of major spending programs, both front door and back door, and to make recommendations on what the Congress should consider doing to put us on a more prudent and sustainable path. There's no question that we need comprehensive tax reform, and that if we broaden the base, we can keep rates low, and in fact, potentially even lower, especially on the corporate side, all right, for competitiveness reasons. At the same point in time, I can also tell you that because of a very simple principle, math, taxes are going up. There's no way that we can solve our structural imbalance solely on the spending side, although my personal view is it's much more on the spending side of reprioritization constraint than the revenue side. But we're going to have more revenues, and the longer we wait to come to the realization that we have to make tough choices on both sides, the bigger the changes are going to have to be, the less transition time, the more risk of passing a tipping point, and the more risk of this.
Would you support a systemic process within the Congress, a litmus test, if you will, so that any member coming before the Ways and Means Committee or any other committee with the tax expenditure would have to meet, a set of criteria in order for the tax expenditure to even be considered?
Absolutely. I think we need, frankly, we need a set of criteria, frankly, for direct spending and indirect spending. Believe it or not, this country's been in existence since 1789. It's never had a strategic plan. Believe it or not, this country doesn't have a set of outcome-based indicators, economic, safety, security, social, environmental, to assess what's working, what's not, how do we compare to others. Believe it or not, we've never gone through a systematic review of major tax preferences or spending programs to find out whether they're future-focused, delivering results, affordable and sustainable. It's about time.
Mr. Hoenig, I don't know if you have any comments on tax expenditures.
I would answer one thing, though, that plays on this, I think is important. If we don't address the issues, front door, back door, the issues you're bringing up, I'm absolutely confident that there will be mounting pressure on the Federal Reserve System to help finance this through monetization of debt. And the outcome for that, for this country, is inflation some point in the future. And, of course, that is a tax. Yeah. And it's the most regressive tax we can put on the American people. So it's so important. I agree so much with Mr. Walker that we address this starting now in some systematic fashion, or we will pay dearly generation, or a lot sooner than that, ahead of us.
Thank you, Mr. Chairman.
We have a little bit of time left. If it's okay with the witnesses, if you're okay with this, we're going to each ask one more question, if that's all right, if people have the questions. Mr. Hoenig, when considering a leverage ratio cap of 15 to 1, would you include off-balance sheet assets in that number? And how do those get considered in monitoring leverage?
What I would tend to do is require a portion of the off-balance sheet to be counted on the balance sheet. If you originate it and push it out, you keep a portion of it, and then your leverage against that. Because I think the fact that you constrain the leverage to that very hard number and keep a fair amount of the off-balance sheet then on your calculation, you will constrain the use of off-balance sheet activities. Otherwise, it becomes very complex. One of the issues in our past crisis around capital is, frankly, the Basel capital standards, which were so complex that they were gamed almost immediately by the institution that wanted to leverage out. So the simpler, the more direct, the better.
If I can, Mr. Chairman.
Mr. Walker, yes,
sir. On that. First, to me, there's a difference between how do you treat them for capital requirements and for regulatory purposes, and what do you do with them from an accounting standpoint. I don't think you want the Congress to set accounting standards. We could be in real trouble if that happens. But I do think that you have to give consideration, as has been mentioned, about what do you do for purposes of capital requirements and regulatory actions.
Thank you, sir. Chair next recognizes the ranking member, Ms. Biggert, if you have a question.
Thank you, Mr. Chairman. This testimony has been really, really good. Really, thank you. Could you just, each of you, just say what would be the first 3 things that you would do right now, what we can do immediately to stop the bleeding, to stop the the debt increase? We'll start with you, Mr. Walker.
First, tell the American people the truth, which is what we're trying to do, about where we are, where we're headed, how do we compare to other nations, the benefits of acting sooner rather than later, the dramatic kind of changes we're going to have to make, the potential adverse consequences to our country and their families if we don't. That means engaging the American people outside the Beltway in ways that haven't been done, representative groups. And frankly, we're going to fund, along with the MacArthur Foundation and the Kellogg Foundation, an effort to do so in 20 cities around the country on June 26th this year, but that's just a beginning. We also are publishing this and distributing it, which each of you have a copy. Secondly, I think next year we should reform Social Security to make it solvent, sustainable, secure, and more savings-oriented. It's a layup. You can miss a layup, but it's a high percentage shot. I think there's pretty much a parameter of what needs to be done there. It's not the biggest problem, but it would be a credibility enhancer and a confidence builder. Secondly, next year, I think we should enact statutory budget controls that will take effect, spending constraints, et cetera, that will take effect once we hit certain triggers as to economic growth and unemployment. And then beyond that, I think that we need to set the table for what would be very tough choices for health care cost reduction, which is the last bill really didn't do much on that, and for comprehensive tax reform that will improve economic growth, enhance our competitive posture, but generate more revenues. Those things, I think, are going to have to be done together because they're going to involve very tough choices, and you're going to have to do trade-offs and probably deal with it as a package.
Thank you.
I would add, I think those are great suggestions. I think there needs to be brought forward to the American people a realization that we have to engage in a shared sacrifice, if you will, that we're all going to have to take some hit, because I find that we all want to do this, but not for our particular area, our particular project. And there has to be this education, communication that would take that forward. I think that has to also be, I guess, incorporated into the congressional process. In other words, we're going to take this forward as a Congress, not as a party, and so we can deal with this. And then I do agree, we need to put budget constraints on ourselves that force us then to face up to these shared sacrifice and these cuts and these taxes that are ours to face.
Thank you.
Shared sacrifice, what a radical notion. That's really something I agree with. And
Thank you.
you're recognized, if you would, Mr. Lynch, please, for up to 5 minutes.
Thank you. Thank you, Mr. Chairman. Mr. Walker, your passing comment regarding the recently passed health care bill, I cannot ignore that. I'm one person who voted against that for precisely the reason that you raised, that the idea at the beginning of the health care debate was that since we were paying 3 times as much as any other nation on health care, that we would squeeze down the costs and use the savings to pay for some health care for the people who weren't covered. And I know I disagree with a lot of my colleagues on this, but you know, it's sort of like throwing an anchor to a drowning man from a budgetary standpoint. Committing $1 trillion when we got all these problems on our plate. I read Mr. Hoenig, your comment that I think both of you have said that we have to realize that the rules of finance apply to us, and that goes for the Fed, that goes for Treasury, and that goes for the people in Congress and to the President. That the rules of finance apply to us, and sometimes around here we act like there's no connection at all to what we do and what we pass, and someone who's going to have to pay the bill somewhere down the road. I read recently in my clips here, I can't track it down, but Moody's, and this was regarding the discussion with Greece and Spain and Portugal and Ireland, and Moody's, someone at Moody's made a statement that the United States ought to be careful because based on the amount of debt that we're acquiring here and the track that we're on, that we could lose our AAA bond rating, and that would be devastating to increase greatly the cost of our borrowing and the loss in confidence in the United States. And I was wondering if you could comment on that and what the repercussions might be if the financial markets, given how we're running our business here, called the United States of America, if there were loss of confidence and we were to lose that AAA bond rating.
I think your concern is very legitimate, and whether it's a financial institution or a company, or the U.S. government, I have a saying that, based on my experience, that once there is a shred of doubt, it's too late.
Right.
And so we're now in a position where we see this wave coming at us, and we can do something about it. But once it gets to our shores, if you will, and this doubt enters, then we will see it reflected in our interest rates, in our value of our currency, and in our future wealth. So we need to do it now. Doubt is going to be the outcome, and that will be a very expensive proposition for us all.
About a year ago, the major rating agencies downgraded the outlook for Great Britain to maintain its AAA credit rating. They didn't downgrade their rating, they downgraded the outlook. Our ratios on total public debt are worse than Great Britain. If we fully accounted for the trust fund obligations and other activities, even with regard to the federal level, they're worse. And so I think the fact of the matter is we benefit from having 64% of the world's global reserve currency, and secondly, home team bias. Those rating agencies are based here. And in my view, there's absolutely no question on the path that we're on. One would have to seriously question how long we will retain a AAA credit rating under our current path. We shouldn't get to that point. And that's why last month we surveyed about 100 top leaders, former leaders from Congress, the executive branch, and the Fed. Chairs and ranking members of Finance, Ways and Means, the Budget Committees, Treasury Secretaries, Fed Reserve Board members, Treasury Secretaries, OMB directors, CBO directors, 100% agreement with a 60% response rate, roughly, that we're on an unsustainable path. Supermajority agreement that we must take concrete actions within 1 to 2 years to avoid the risk of passing a tipping point. Numbers like that are clear and compelling. So we've got to move past denial. We've got to move past delay. We've got to have a plan, and we've got to start acting.
Thank you both. I yield back.
Thank you, sir.
Mr. Chairman, could I ask unanimous consent to allow Mr. Royce from California to, he's a member of the General Committee, but not
Certainly, that is granted. Mr. Royce, you're recognized, sir, for 5 minutes.
Well, I appreciate it, Mr. Chairman. I had a question for Mr. Hoenig. In a recent book co-authored by two economists, Rogoff and Reinhardt, they note the painful consequences of the rising government debt load that often follows, financial implosion or a financial crisis. And despite vocal warnings from economists, the United States is following the pattern that they set out rather blindly. We were over-leveraged prior to the financial crisis, but the Federal Reserve and the U.S. government have lent or spent or guaranteed about $8.2 trillion to prop up the economy in the last 2 years. And you also throw into the mix here that Chairman Bernanke has said our budget deficits and the budget proposal put forward by the administration going forward is unsustainable. So we don't see things getting better with these trillion-dollar deficits that we are budgeting for now. The IMF and the OECD are projecting that the stock of public debt in advanced economies is going to double and reach an average level of 100% of GDP in the coming years. So I would ask you, we've been through a financial crisis where much of the private sector debt was simply transferred to the federal government. In essence, that's the bottom line. And that's contributed then to these unsustainable federal deficits. So where does this road lead? And do you foresee a financial crisis that now morphs instead into a sovereign debt crisis here in the United States?
I think that the steps that were taken in the crisis to staunch it, to end it, were taken aggressively. I think now we have to be prepared to reverse that. And we need to do it carefully and systematically, but we need to reverse it. These debt levels that we've been talking about here this morning, whether it's the financial institutions, the federal government, and even the Federal Reserve's balance sheet needs to be addressed and reduced. And I think that's paramount importance. Or, as Rogoff and Reinhardt have shown, we will compromise our future, and as we've been talking here this morning, it will as well. And I think, as I said earlier, there will be increasing pressure. If this isn't addressed sooner and systematically, and people don't have confidence that we're going to address it, then we will see pressure for the Federal Reserve to monetize more of this debt. The inflationary pressures will rise, and there will be a strong impact on the dollar long term and on our nation's wealth. So it's
well, that is the concern of a number of economists, that the path of least resistance here might be runaway fiscal deficits, which will then be monetized by the Federal Reserve. Right. And I think you recently gave a speech highlighting the possibility that Congress could soon be knocking on the Fed's door to monetize the debt. Right. Are you concerned with the precedent that's been set by the Fed in this regard? Because last year the Fed has bought $1.8 trillion of Treasury securities and agency debt. And the other issue that I just asked about, which comes out of that same book by Rogoff and Reinhardt, is that the buildup of excessive debt, they say, inevitably leads to stagnant economic growth going forward, which you alluded to. Clearly, there is the need for deleveraging that lies ahead for our economy, both in government and privately held debt. And instead, we seem to be piling on, especially if you look at the increases in all of the agency spending, the appropriations, the separate appropriations bills, which go up by double digits. Do you foresee a stagnant economy as long as this level of debt remains? Well, what's your forecast here?
Well, first of all, yes, I am concerned by the precedent set, and I think we need to, that's why I say we need to reverse that quickly to bring our balance sheet back down. Now, we need to do it systematically and carefully, but we need to do it. If we don't, and we get ourselves into an environment of growing debt, unsustainable, as Mr. Walker had pointed out, and we then put pressure to monetize it, which would cause us to have inflation, we will endanger our economy, and stagnation is a possibility. It's unavoidable if we don't take action now.
Thank you, Mr. Hoenig.
Congressman, if I can respond
absolutely.
quickly. First, in my testimony, I talked about the 4 parallels between the factors that caused the mortgage-related subprime crisis and the federal government's own finances. We need to learn lessons from that. Secondly, with regard to the book you're referring to, I think it refers to the fact that once you reach debt equal to about 90% of the economy, then it has an adverse effect on economic growth, and once you get to 100, it's a real troubling. Well, if you count the Social Security and Medicare debt, we're at 89%. And growing rapidly. That doesn't count the GSEs and things of that nature. And then lastly, you can't monetize your way out of this problem. And let me tell you why. Because while monetizing your way out, which creates an inflation risk, might help deal with the current debt and lessen the burden of the current debt, the real threat to the future of this country is the $45 trillion in off-balance sheet obligations, $38 trillion for Medicare alone, that grows faster than inflation and faster than the economy. You have to make tough choices. You need to do it within 2 years at least to start, or else we could be facing something that we don't want to see in this country.
Thank you.
Thank the gentleman, and I would at this time like to thank our panel members here, Mr. Hoenig and Mr. Walker, for your testimony and for your answering our questions. It's been a very, very good exchange, and I very much appreciate that. I'm advised that votes will be called in the very near future, probably in the next 5 to 10 minutes. And I would like to excuse the first panel, and again, thank you for your testimony and your service, and ask the second panel members to be seated so we can maybe just get at least preliminarily started here and then move on. Thank you again. I'm pleased to introduce our second panel of witnesses, and please work with me and forgive me if I mispronounce any names here. I'd like first to hear from Ms. Orice Williams, Director of Financial Markets and Community Investment at GAO. Next will be Professor John Geanakoplos and James Tobin, Professor of Economics at Yale University. Then we'll hear from Professor Viral Acharya. Excuse me. Will you say it, sir? Okay. Professor of Finance, Stern School of Business at New York University. And finally, we'll hear from another David Walker, a different David Walker, Professor David A. Walker, who's the John Largay Professor at the McDonough School of Business at Georgetown University. Without objection, your written statements will be made part of the record. Ms. Williams, you're recognized, ma'am, for 5 minutes.
Thank you. Chairman Moore, Ranking Member Biggert, and members of the subcommittee. I appreciate the opportunity to testify before you this morning on the role of leverage in the recent financial crisis. As you know, the Emergency Economic Stabilization Act of 2008 mandated that GAO study the role of leverage in the crisis. My statement today is based on that report. While the report covers a wide range of issues, I would like to highlight a few key points concerning how leverage is defined, its cyclical nature, how it's constrained, and regulatory limitations. The buildup of leverage during the market expansion and the rush to reduce leverage or deleverage when market conditions deteriorated was common to this and past financial crises. Leverage traditionally has referred to the use of debt instead of equity to fund an asset and has been measured by the ratio of total assets to equity on the balance sheet. But the recent crisis revealed that leverage can also be used to increase an exposure to a financial asset without using debt, such as by using derivatives. Given the variety of strategies to achieve leverage, no single measure can capture all aspects of leverage. Our findings concerning the role of leveraging and deleveraging in the recent crisis reveal that leverage steadily increased within the financial sector before the crisis began in mid-2007, and banks, securities firms, and others sought to deleverage and reduce their risk during the crisis. While this work, which builds upon the work of others, suggests that efforts taken to deleverage by selling assets and restricting new lending could have contributed to the crisis, others noted that the crisis was the result of prices reverting to their fundamental values after a period of overvaluation. These varying perspectives illustrate the complexity of the crisis and, given the range of assets involved, are not necessarily contradictory. Moreover, some argue that leverage created vulnerabilities in the market that increased the severity of the crisis. In addition, subsequent disorderly deleveraging by financial institutions may have compounded the crisis. For example, some studies suggest the efforts taken by financial institutions to deleverage by selling financial assets could cause prices to spiral downward during times of market stress and exacerbate a financial crisis. Second, the study suggested that deleveraging by restricting new lending could slow economic growth. However, other theories also provide possible explanations for the sharp price declines observed in certain assets. The issues raise questions about how leverage is constrained, which varies by type of institution. For example, for federally regulated institutions, regulators can limit leverage through minimum risk-based capital, leverage ratios, and liquidity requirements. However, for other institutions, such as hedge funds, market discipline, supplemented by regulatory oversight of institutions that transact with them, can serve to constrain their use of leverage. The crisis revealed limitations in the regulatory approaches used to restrict leverage. For example, regulatory capital measures did not always fully capture certain risks, which resulted in some institutions not holding capital commensurate with their risks and facing capital shortfalls when the crisis began. Moreover, regulators faced challenges in counteracting cyclical leverage trends. The crisis also revealed that with multiple regulators responsible for individual markets or institutions, none has clear responsibility to assess the potential effect of the buildup of system-wide leverage or the collective effect of institutions' deleveraging activities. Finally, a principal lesson of the crisis is that an approach to supervision that focuses narrowly on individual institutions can miss broader problems that are accumulating in the financial system. In that regard, regulators need to focus on system-wide risks to and weaknesses in the financial system, not just individual institutions. In closing, I would like to note that since the onset of the crisis, regulators have continued to reevaluate capital standards, namely Basel II, and the countercyclical nature of leverage and capital. However, efforts to monitor leverage must include a mechanism to evaluate the amount of leverage in the system in order to better identify and mitigate potential systemic risk. Mr. Chairman, Ranking Member Biggert, this concludes my oral statement, and I would be happy to answer any questions at the appropriate time.
Thank you for your testimony. The chair next recognizes Professor Geanakoplos. You're recognized, sir, for 5 minutes.
Thank you for inviting me to talk today about managing leverage, managing the leverage cycle. For a long time, we've recognized the need to manage interest rates. That's what the Federal Reserve does, but we don't have a regulator to manage leverage. And I've written about this for 10 or 15 years. I wasn't the first one to think of this idea. Shakespeare, 400 years ago in The Merchant of Venice, explained in a negotiation over a loan that you had to figure out not only the interest rate, but also the collateral. And if we ask, which did Shakespeare think was the more important, nobody can remember the rate of interest that Shylock charged, but everybody remembers the collateral, the pound of flesh. The play ends, by the way, with the regulatory authority, the court, deciding not to change the interest, not to change the principal, but to change the collateral. Should have been a pound of flesh, but not a drop of blood. And that's what I'm advocating today, that we manage leverage and not pay so much attention to interest rates. Now, I'm talking about securities leverage. When you get a house at 20% down payment, that means a 5-to-1 leverage, the cash divided into the amount of assets. That's what I'm talking about. The reason I wrote about this is there's a puzzle in economics. How could it be that one supply equals demand equation determines two things, the interest rate and the leverage, or the amount of collateral? Well, in my theory, it does. I resolved that problem. So leverage is important for 3 reasons, 2 of which people know. The more leveraged you are, the riskier your situation is. The asset changes by 1%, your profits go up by 5% if you're leveraged 5-to-1. Also, there's no recourse aspect of collateral. You can walk away from your house, and if the house goes to zero, you lose the $20 you put down, the borrower loses the $80. But there's a third aspect of leverage that didn't get so much attention, which is the main thing I called attention to, which is that with a lot of leverage, very few people can own all the assets. And the implication of that is the more leverage in the economy, the higher the asset prices. The less leverage, the lower the asset prices. The reason for that is if you think of people, the buyers, on a continuum, for the most enthusiastic at the top to the least enthusiastic, wherever the price is, the people above that are going to think that it's a good deal and they'll be buyers. The people who are less optimistic will think that it's a bad price and they'll be sellers. If you allow leverage in the system, the marginal guy, the guy on the threshold of buying or selling, his opinion is determining the price. If leverage goes up, you need fewer people at the top to buy all the assets. The marginal guy on the threshold is higher, and so the price now reflects his opinion, which is a higher opinion because he's a more optimistic person. That's why prices go up when there's more leverage. Okay, and the reason for this heterogeneity between people is some people more risk tolerant, some people like to live in the houses more, many reasons. Some people are more optimistic. So the leverage cycle is that there's too much equilibrium leverage in normal times and therefore too high asset prices, and then suddenly there's too little leverage in a crisis and therefore too low asset prices. And this bouncing up and down of asset prices is very harmful to the economy. And the crisis always begins the same way. There's bad news, but it's not just bad, it's scary. For example, they tell you your plane is 10 minutes late. Well, 10 minutes isn't so bad. It's that you start to worry maybe it's going to be an hour or two late. A bank announces it's going to lose $5 billion. That's not the end of the world, but if it's going to lose $5 billion, maybe it'll lose $10 billion, and that's what you're worried about. Or delinquencies and homeowner delinquencies go from 1% to 5%. The real problem is people now think they might go to 30%. So the next stage is the lenders get nervous and they cut lending and they increase margins and leverage starts to collapse. And then the optimistic buyers, when the prices are going down, they lose all their money. So a price might go down from 95 to 69, not because anybody thinks their own information justified. The bad news isn't enough for anyone to think it should go down that far. But the optimists who bought at the beginning, the top 13% say when the price starts to go down, they get wiped out. Then the next group who's going to buy after the crash, the next group, not only not as optimistic, but they can't borrow the money to buy it. So so it takes a lot more of them to buy it. And so the marginal buyer goes way down, way below where he was before, and the price is lower, not because of the bad news alone, but because of the bankruptcy of the optimists, and also because leverage is so far down. So that's my theory, and this has recurred over and over again in 94, 98, 2007. So just to show you some data, there's a famous graph, that green curve, which is Shiller's home price data. It went from 2000 at 100, 90% up to 190, and then dropped to 130. And he called it irrational exuberance. But if you look at the down payments, the purple, it went from 14, measured from the top, 14% down to 2.7% down, and then to 20% down. It reached the peak at exactly the same time. If you look at toxic mortgage security prices, they collapsed, went from 100 to 60, and now they're going back up to 80. Well, if you look at the blue line, that measures down payment again in reverse direction, you see that leverage suddenly collapsed, and leverage went back up, and that's why prices are going back up. So the leverage cycle was worse this time than all the previous times. I'm just going to go 20 more seconds. Worse this time than all the previous times because the leverage wasn't just a few financial institutions, but millions upon millions of homeowners. And so we had a double leverage cycle, millions of people plus our financial institutions, and also we introduced CDS, which is another way to leverage. So what should we do about the leverage cycle? The most important thing to do is monitor leverage, securities leverage. Go to all the big financial institutions and ask, what is the down payment you're requiring for housing, for securities that people are buying, and publish that data every month. And also measure people's leverage. Put CDS on an exchange and regulate leverage in normal times. Don't let banks make 2% down payment loans on houses and banks lending on mortgage securities. Then you have to, okay? And the last thing is people keep, this is my last slide, people talk about monitoring leverage with the 15% rule. That's been advocated by the previous panelists. In my opinion, that's a mistake. We should be looking at leverage at the securities level, not at the investor leverage. What's the down payment on securities? Leverage can move from one institution to another. If you require 15% for some institutions, it'll move to some other place. People can lie about their leverage. You can't lie about what the down payment is because there are two people you can check what the down payment was. Thirdly, and most importantly maybe, leverage at the investor level goes in the wrong direction. When there's a crisis and it's hard to get a loan and the down payments go way up, the investor leverage looks like it's going up because their equity is disappearing. So debt to equity is going up just when the leverage is actually collapsing in the system. And also there's less pressure on a regulator if he monitors security leverage. Sorry I went over. Thank you.
Thank you, sir, for your testimony. The chair will next recognize Mr. Acharya, is that correct, sir? For up to 5 minutes. And I would advise the people in the room here that votes have been called. We have about 10 to 12 minutes, I think, for votes. So if we can get both of these last remaining witnesses for 5 minutes each, we'd appreciate that. Sir, you recognized?
Thank you, Mr. Chairman and members of the subcommittee. Along with my colleagues at the Stern School of Business, New York University, I've co-edited 2 books on the financial crisis and co-authored research papers that help understand how the financial sector escalated its leverage before the crisis and what can be done about it in future. Much of what I say today is based on this research. We seem to witness on a somewhat regular basis episodes in which financial intermediaries are all overextending credit and are themselves funded with excess leverage. When the economic cycle turns downward, they fail in a wholesale manner, requiring massive government interventions. While leverage has its bright side in expanding finance for households and the real economy, its dark side is precisely this boom and bust cycle. Unfortunately, this dark side has become enduring. With each cycle comes in place more government intervention and guarantees of financial sector's debt, some explicit such as deposit insurance, and others implicit such as too big to fail or too systemic to fail. The result is that financial firms find it cheap to borrow and pursue returns without sufficient regard for risks. One of the most salient such episodes was the period since 2004, during which the financial sector in the United States and in many parts of the Western world grew its balance sheet at an unprecedented speed and did so mainly through leverage. There were 3 primary failures in my view that led to this escalation of leverage. 1, access to government guarantees that were not paid for, especially for the commercial banks and government-sponsored enterprises. 2, ineffective enforcement that allowed bank regulation to be arbitraged, that is circumvented by a sophisticated financial sector. And 3, in case of investment banks and the insurance sector, simply poor design of regulation. The end effect of these failures was that large and complex financial institutions, 10 of which owned over 50% of the financial sector's assets, operated at historically high leverage, in some cases exceeding 25:1, or in other words, $24 of leverage on a $25 balance sheet. Much of this leverage was undertaken in the shadow banking world, the less regulated or unregulated part of the financial sector. This part of the financial sector consists of off-balance sheet entities that are connected to but do not appear on bank balance sheets, borrowing and lending between financial firms, including through repos or repurchase agreements, and the over-the-counter derivatives. Much of this leverage was also short-term in nature, to be rolled over each night or week, and yet it funded long-term and illiquid assets such as subprime loans. This exposed the financial system to great risk from a secular economic downturn. And because the leverage was highly opaque, when financial firms failed, uncertainty about how losses would transmit to others paralyzed the system. In the end, the government and the Federal Reserve ended up bearing much of the losses. What can be done to deal better with this boom and bust cycle of leverage in the financial sector? In interest of time, I'll focus only on those regulatory options that directly deal with leverage in good times. First, current capital regulation does not take account of the leverage structure of a financial firm's balance sheet. This major shortcoming should be addressed, for instance, by imposing a tax on leverage, or better, by introducing upper limits on leverage, such as 15:1, as has been employed successfully in other countries such as Canada, or better still, by embedding leverage information in supervisory tests to assess whether banks can withstand extreme losses in economic downturns. Second, the regulation of the shadow banking world needs to be brought in line with the on-balance sheet regulation of financial firms. Any attempt to regulate leverage that ignores the shadow banking world would only lead to further growth of off-balance sheet forms of leverage. In addition, greater transparency of the shadow banking world needs to be legislated so that regulators and market participants have timely and accurate information to understand and, if needed, restrict and discipline the leverage of financial firms. And last, but not the least, the government should plan for a graceful exit from the large number of guarantees provided to the financial sector, not just as part of the rescue package in 2008, but from well before. In particular, reform of the financial sector should also include reform of the government-sponsored enterprises. I'll be happy to provide more detailed proposals on these in the question and answers. Thank you, Chair.
Thank you, sir. And Mr. Walker, you're recognized for 5 minutes, and we do have votes again have been called, but I think we have time for your testimony. Then we're going to take a break for votes, and then we'll be back for questions.
Thank you. Chairman Moore, Ranking Member Biggert, and subcommittee members, thank you for this opportunity to testify in front of the House Financial Services Oversight and Investigation Subcommittee. I'm David A. Walker, the John A. Largay Professor in the McDonough School of Business at Georgetown University. Large firms that are managing their risk effectively are not necessarily too big, and our economy needs their services. Some mismanaged firms needed greater regulation. Some aggravated the financial crisis, and many of those have already failed. Breaking up a large firm that shows unreasonable risk would be much preferred to future bailouts. There are 3 recommendations I would like to offer to the committee. Number 1, merge the Office of Thrift Supervision into the Office of the Comptroller of the Currency as soon as possible. Number 2, do not subject small insured depository institutions to unnecessary additional capital restrictions. Basel I and Basel II are more than sufficient. And number 3, assign consumer financial protection responsibility to the FDIC without creating a new agency and an additional bureaucracy. For the record, I submitted copies of 2 papers, a peer-reviewed study on long-run credit growth in the U.S., co-authored with Dr. Thomas Durkin, former senior economist with the Federal Reserve, and my Georgetown colleague, Professor Keith Ord, and a second policy paper on impacts of TARP on commercial banks with Max Gaby. The issue Durkin, Ord, and I analyzed is how levels of consumer credit have changed over the past 60 years. Surprisingly, we show that the aggregate real consumer credit, adjusted for price increases and excluding mortgage credit, has increased at about the same annual rate as real U.S. disposable income. Conclusions with regard to mortgage credit are very different, and with subprime lending, every segment of the industry had abuses. Perhaps the greatest problem in the housing crisis was poor supervision by the Office of Thrift Supervision. The failures of IndyMac and Washington Mutual were failures of holding company thrifts supervised by the OTS. I believe that if all holding companies were supervised by the Fed, the results would be somewhat different. This would be just one more example where the independence of the Federal Reserve is essential. I'm a strong proponent of merging the OTS into the Office of Comptroller of the Currency, and I wish the Congress could pass such a separate bill to accomplish this very quickly. Mark Flannery has proposed requiring large banks to hold debt instruments he calls contingent capital certificates. They would automatically convert from debt to equity if the market value of a large bank's equity fell below an established threshold. This eliminates regulatory delays and negotiations when a large bank might be in jeopardy. Leverage of insured depository institutions can be examined by a simple ratio that I've talked about in my testimony, where you take liabilities minus deposits as a ratio to Tier 1 capital. My research shows that risky large banks and large savings and loans could be identified by this ratio. I recommend that you not create a new government agency for consumer financial protection. Please consider placing the responsibility within the FDIC. As an independent agency with separate budget authority, many necessary consumer protection systems already in place, and an existing consumer affairs department, the FDIC is ideally suited, in my opinion, to implement the consumer financial protection that the Congress deems necessary. The aggregate fiscal debt in the U.S. has increased dramatically since World War II under both Republican and Democrat.
Mr. Walker, may I interrupt you? And I apologize for doing this. We have 2 minutes and 15 seconds left before the conclusion of votes, so I think we're going to have to stand in recess right now, and I would ask you if you would finish your...
Sir, I could finish in 30 seconds.
Very good. Thank you.
The IMF establishes a 5% country target maximum of fiscal deficit ratio to GDP. The Honorable David Walker has already talked about this in great detail, and I wouldn't attempt to repeat what he says. I just want to also urge the subcommittee not to burden the U.S. with any further taxes that are regressive, like the VAT tax. That concludes my testimony. And, sir, I'm sure you appreciate that for academics to do anything in 5 minutes is monumental. At Georgetown,
same for Congress, and we're going to stand in recess right now. I thank the witnesses. We'll be back probably in about 20, 25 minutes. If you can remain here for questions, I'd appreciate it very much. Thank you.